Welcome back to the channel, everybody. I'm Jay from Investonomics, and it's that time of the week again. It is lecture time. So this week we're going to be doing our third finance video, and it's going to be on an introduction to bonds. So this will be part of a multi-video series where I'll just be covering some basics about bonds, some different types of bonds, some different aspects, and how you can best use them in your investing portfolio to maximize your returns. So I hope you enjoy this one, and I'll see you next week. Welcome back, everybody, and today we're going to be doing an introduction to bonds, and this is going to be the third finance video, and this also kind of ties into investing. So although owning a stock is owning a small piece of a company, when you own a bond, you're essentially lending your money to a company or government, and this amount of money is going to be repaid in the future at a preset date. A bond allows any investor to become a creditor to the borrower, so a company or the government. And this, like I said, can be a government or a corporation or a municipality as well. Before purchasing a bond, however, all the aspects are made clear in a contract, and this specifies when the loan must be repaid, called the maturity date, and the original investment or the principal must be repaid, and this value is also laid out. In order to make this type of investment attractive to investors, the borrower is forced to pay interest on the loan. So this is the corporation or government, and this is only for coupon bonds. This is often referred to as the yield or coupon rate, and it follows that such bonds are called coupon bonds. This means they pay an interest. So this interest can be paid either quarterly, so once every 3 months, semi-annually or every 6 months, or once per year. Bonds that don't pay interest are called zero coupon bonds or discount bonds. Zero coupon bonds are usually treasury bills, or called T-bills, which are short-term government bonds, and these are the discount bonds as well. So discount bonds are called this because they are bought at a discount from their face value, and this gives them their value rather than the coupon payments. So the face value is the amount repaid to the creditor at maturity. And it's usually, as standard, set to be $1,000, and it's discounted from this when you buy it. Oftentimes, the coupon or interest rate is expressed as a percentage of the face value. So for example, if we have an 8% annual coupon rate, and is actually 8% of the $1,000 face value, so we get $80 paid each year, and this continues until maturity. Bonds are referred to in general as debt securities. They usually are used to fund expansions or large projects for corporations or businesses, and these are called corporate bonds, or for government or municipal expenditures in order to reduce their debt, and this is the government or municipal bonds. In terms of risk, a bond's risk stems from the risk of the borrower's entity and their risk for bankruptcy. So for example, if you hold a 20-year maturity USA government bond and the government declares bankruptcy, which is obviously very unlikely, you would lose your principal. And this is the initial amount that you paid. The yield also reflects this risk. So as maturity increases, so does the yield, because there's higher risk if you hold it longer, and corporations are more risky than governments, which also means you get a higher yield from corporate bonds than from government bonds. A valuable aspect of corporate bonds, however, is that if Chapter 11 bankruptcy is filed, bondholders are the first to get paid from the leftover money. Shareholders are the last. So this is a definite benefit for if bankruptcy is declared. The relationship between yield and maturity has been extensively studied in finance, and it's still a hot topic today. So not only do yield and maturity have a generally positive relationship, so this means that if one falls, so should the other, so positively related. And again, if one rises, so should the other. This has been linked to the economic climate and how the economy is doing. And this is called the yield curve, or the term structure of interest rates, which is another term commonly used. When economic times are good, further out maturities offer higher yields. And this is the opposite of what happens in bad economic times. And this provides a basis for economists and finance individuals to be able to track this type of thing, to look at the economic outlook. So a positive economic outlook has a positively sloped yield curve, and a negative economic outlook has negatively sloped yield curves. So I'll show you this now. So here we go. We have a positive economic outlook version of the yield curve, and we have yield on the vertical axis and maturity on the horizontal. And I've just done some arbitrary maturities here. And this is in positive economic times, so we see that the further out the maturity, the higher the yield must be. And similarly, this is for negative economic times, or like for COVID, this is the case where we had a negatively sloped yield curve. And this means that we get less yield for higher maturity assets. So in positive economic times, there's more reward for holding the bond for a longer period of time. But in negatively economic times, short-term bonds are rewarded more than long-term bonds because of the uncertainty that's introduced. So the relationship between the price of the bond and the yield is another very interesting relationship, and they are inversely related rather than positively related. So a higher yield discounts the price of the bond relative to the face value, so the price you buy it at. And some more terms you should know is an annuity, which is a bond that has a maturity of 1 year, and perpetuity, which is a bond that does not mature, so no maturity at all. And so you keep receiving coupons, but you don't get your principal back. So the Bank of England used to issue these perpetuities, but they're not as common anymore. So next time we're going to further investigate the types of bonds and how they operate. So see you all next week.